One of the biggest selling points for actively managed funds has been the claim that because they're able to be more flexible with their investment choices, they'll be able to better protect investors' money during economic hard times. And it's a claim that makes a lot of sense on the surface. Passively managed index funds, by and large, have their investment decisions made for them by the index that they happen to be tracking. An index fund tracking the S&P 500 will have the bulk of its investment money spread across the 500 or so funds that make up the S&P 500. And the amount of money that they put into those individual companies will be determined, largely, by the weight that they are given within the S&P 500 index. For example, as of this writing in early December 2021, Apple and Microsoft each make up about 6 to 7% of the value of the S&P 500. So a passively managed index fund tracking the S&P 500 would put roughly 6 or 7% of its money into Apple and Microsoft, whereas Gap makes up a measly 0.009% of the S&P 500's value, and would therefore have less money put into it through the index fund. You get the point. There isn't a whole lot of wiggle room there for passively managed funds, whereas investment managers who oversee active investment funds can choose to select a small subsection of those big blue-chip companies, assign different weights to them depending on what they see going on in the economy, or go a different way entirely and invest in companies that aren't even listed on the S&P 500, or whatever index it is they're being measured against. However, does this added flexibility and discretion when choosing investments actually lead to superior financial protection for investors? Do actively managed investment funds earn their reputation? Well, as fate would have it, after a decade-long run of mostly strong markets, 2020 threw us a curveball in the form of one of the fastest downturns and recoveries on record. The exact sort of situation where investing flexibility would, theoretically, be the most valuable, since you'd be able to ditch losing investments quickly before they've totally cratered, and you'd be able to take advantage of sudden and overblown dips in otherwise solid companies. Now that the smoke from that particular wreckage has cleared, let's take a look at how investment managers did during one of the most chaotic years in recent financial memory. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. So there are a couple of things that I wanted to look at today. The first is, obviously, how well money managers did in 2020 relative to other, more normal years. Ideally, what we'll see is that actively managed funds, more often than not, outperformed their passive counterparts in 2020, as that would suggest that the reputation of capital preservation is well earned. The second is the long-term picture. This is mainly so that we can see how the performance of active funds, whether good or bad, during this most recent downturn impacted the long-term viability of the approach, i.e. whether or not active funds managed to earn more for their investors after accounting for fees over the long term, and if so, by how much. This is important to consider, because unless you have a crystal ball, it's highly unlikely that any of us who are currently investing in mostly passively managed funds will be able to predict a downturn before it happens and then switch up our investments to something more actively managed in an effort to preserve our capital. In other words, we're likely going to experience some ups and downs regardless of which approach we go with. So we're going to want to examine which has done better during a longer period that saw both good and bad years. With that being said, let's start by examining how money managers did in 2020 relative to their performances in 2019 and the 12-month period ending on June 30th, 2021, per the most recent data available at the time of this writing from Morningstar's semi-annual active-passive barometer report. The chart on your screen now shows the percentage of actively managed funds in Morningstar's database that outperformed their passive peers in various categories during the time period measured, after things like expenses and fees are accounted for. In general, anything above 50% is good, as that suggests that, more often than not, the actively managed funds outperformed their passive counterparts net of fees. Ideally, what we'd like to see are money managers succeeding more often than not in the 2020 period, since that's when the most recent crash got started. However, at least in terms of the US stock market, that rarely seemed to be the case. On the bright side, things do look better when we turn our attention to stocks outside of the US, particularly in the case of the larger foreign companies. Meanwhile, real estate figures suggest roughly as much success for money managers as they saw in 2019, but fixed income struggled a bit relative to their most recent data in 2021. Unfortunately, over the longer term, things tend to get pretty bleak pretty fast. As you can see from this chart, which details the percentage of actively managed funds that outperformed their passive counterparts, net of fees, for the 12-month period ending on June 30th, 2021, large cap US stocks see their success rate fall from somewhere in the mid 40% range when looking at a 1-year time period, down into the teens or even single digits when looking over the course of a decade or more. And the fall off happens pretty quickly, with large cap value stocks, the most successful of the large cap space during this particular time period, falling from a near 49% success rate over 1 year to just under 30% over the past 3 years. Mid-cap stocks performed fairly similarly over the past year, with the value and blend sections outperforming their passive peers better than 40% of the time, but growth stocks struggling. Mid-cap growth stocks were successful more often than not over the past 3 to 5 years, but their success rates fell off pretty sharply after that. Much the same could be said about the small cap space. International equities have often swung wildly in favor of either passive or active approaches for several years now. This most recent year favored the active approach, but on the whole, the long term still seems to favor the passive approach more often than not. Given all that information, it should come as no surprise that over the long run, global equities tend to favor passive investing approaches more often than not. US-based real estate appears to follow a similar trend to stocks, but global real estate seems to benefit from an active approach more often than it doesn't, even when looking back over the past decade. And finally, there's fixed income, which is probably the area that benefits the most from active management. The benefits for intermediate core bonds tend to fall off over time, but corporate and high yield bonds seem to give you roughly coin flip odds or better for outperformance, even over a decade-long span. So what we see here is that, for the most part, stocks do not seem to benefit all that much from the flexibility of active management, especially if you're investing in US-based companies. There were some cases where active managers tended to outperform passive index funds during this most recent downturn, namely when it came to international stocks and the mid-cap value and small-cap growth spaces, but most of the time they lagged. And over the long term, almost every investment type saw noticeable declines in their success rates, with some even falling all the way down to the single digits. The trend is further showcased in the typical total return figures for active and passive investment funds. As you can see from these charts showcasing the difference in the average annualized total returns for active and passive funds over the past 10 years, with positive return figures suggesting passive investments outperformed active investments, active funds have often trailed their passive peers by 1% per year or more for US-based stocks. Unsurprisingly, given the relative higher outperformance rates we saw a moment ago, the return differences for global equities, real estate, and bonds were, for the most part, less pronounced than for US-based stocks. Active managers even posted average total returns, net of fees, that exceeded their passive peers by over 1% per year for the foreign large value, emerging markets, and global real estate categories. So in the end, do actively managed funds earn their reputation for being a superior preserver of financial capital? Well, it depends on what exactly you're looking at. On the one hand, there is some evidence that active managers can outperform their passive peers during market downturns, particularly for investments outside of the US. It's by no means a slam dunk guarantee that the fund you pick outperforms a passive index fund, and even if it does, it may not actually be by all that much once the smoke clears, as illustrated by both the declining success rates seen for most actively managed funds, even when comparing them over just a 3-year period, and the generally small margin of victory for total returns in most instances, but it does seem to be a reasonably possible outcome. On the other hand, it seems that for a lot of investments, whatever benefits you may get during a market dive quickly evaporate during and after the recovery. This appears to be especially true for US-based stocks, which almost universally saw their active management outperformance rates decline significantly when looking at longer time periods. But that trend was also seen in just about every other investment. In fact, the only 2 investments that managed to maintain even a success rate of 50% when looking at their longest available time horizon, which was 10 years in both cases, were corporate bonds and global real estate, neither of which would have been considered strong long-term growth options during that time horizon. Just to put some numbers to it, actively managed global real estate had a total annualized return of about 6.5% per year over the past 10 years, and corporate bonds returned a little under 5% per Morningstar's data. Compare that to passively managed US stocks, which returned anywhere from 11.5% to 18.5% per year over that same time frame. That would mean that a $10,000 investment in an actively managed corporate bond fund 10 years ago would have grown to somewhere in the neighborhood of $16,100 today. Global real estate would have appreciated to around $18,700. Passively managed small-cap value stocks, the worst performer of the US stock categories during this particular time period, would have grown to be worth approximately $29,400. And large-cap growth stocks, the best performer outright during this time period, would be worth about $54,600. And I don't know about you, but to me, differences in long-term results like that are worth the possibility of stomaching a little extra volatility in the short term. If protecting my capital is the name of the game, the data suggests that switching to an actively managed approach is probably not the best long-term play in most situations. More often than not, I'd likely be better off sticking with a combination of passively managed funds that are well diversified across different asset classes, regions, and currencies, while making sure that I build and maintain a strong budget and emergency fund should something unexpected or undesirable come to pass. But what do you think? Do actively managed funds earn their reputation for capital preservation? Let me know in the comments section below. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.